Where is he? Okay, last session, last but not least, right? Last but not least. Just a few announcements before we get started. My colleagues will definitely confirm this, but none of this would have been possible without a lot of assistance to me because I am completely incompetent when it comes to doing a lot of these things. So a lot of the thanks goes to Frank Fardone. Who couldn't be here this morning, Michelle Werner, she was here yesterday. Frank, as you also know, is the machine, the well-oiled machine that's running the journal in terms of your submissions and everything else and refereeing. So he's a super invaluable part of the journal as well as the conference. I also want to thank you because none of this would be possible without our authors and our referees and our associate editors. So, a lot of people will, during a conference or just in general, might come up to an editor and say, thank you so much for publishing my paper, or, whatever it might be. And when somebody comes up to me and says, thank you so much for publishing my paper, I think, do you know how many bad papers we get? You absolutely don't need to thank me. We need to thank you for sending us papers that we're going to accept into the journal. So we receive well over 600 papers each year. We publish, I don't know, what is it, 45 or something like that? So we get a relatively small percentage of papers that are sufficiently high quality or turn into published papers. So we thank you for sending us your good papers. Please continue to do that. You are responsible, the people in this room are responsible for a fairly substantial number of those publications, as well as a substantial number of the referee reports. So I don't know what the numbers are, but I would guess the people in this room make up probably half the referee reports or something like that we get during a year. Although the editors get to put their name on the paper and get thanked, and we get all that stand up in front of you and talk and whatever it is, you are doing way more of the work than we are. So for every hour I spend looking at a paper, I know a referee has spent 5 or 6 hours sort of working on that, or even more than that. So the referees are putting in a tremendous amount of time. The authors are putting in a tremendous amount of time. So none of this would be possible without you guys. So without further ado, although I'm going to note one thing, at the end of this, at 11:45-ish, we're going to vote on best paper, best discussant. So please do stick around. I'm going to get assistance with the polling again, given my competence. Christina's going to come up and assist me. But let's get started with this paper, Imperfect Expectations and Loan Loss Forecast. We have Yao Lu. You have 25 minutes. Is that what we said? 20 minutes? Scott Lau, who was over here the other day, I'm not sure where he is. Scott is back there. Okay, he's going to come up and discuss. Take it away.
All right. I would like to start by thanking the editors for including this paper. It's such a great honor to be here and share our work here. This is a co-authored project with my colleague Sanjeev Bhojraj and also Anya Kleymenova from the Federal Reserve Board, Miao from Boston College, and also Partha Sengupta from the Office of Comptroller of Currency. So what we do in this paper is to study whether banks' forecasts about their future loan losses are subject to behavior biases. Just a quick disclaimer that views here are those of the authors, not the views of the OCC or the Federal Reserve. So as accountants, we care about banks' forecasts about their loan losses because those forecasts are just the first step you need to do your loan loss provisioning, which is a critical accounting treatment for banks' expected loan losses. And what banks do is that they set aside this provisioning for future loan losses in anticipation for the realization of those loan losses in the form of net loan charge-offs or NLCO. And therefore, the quality or the accuracy of your forecasts about those future loan losses are going to be very important for the quality of banks' financial reporting and more specifically, the timeliness of banks' loan loss provisions. And so we are talking about forecasts, and we learn from the behavioral finance or behavioral economics literature that forecasts can be influenced by behavior biases. And the particularly important one is the representativeness heuristic that is introduced by Kahneman and Tversky. the idea is that people under the influence of this heuristic tend to overestimate the likelihood of the future state of the world that is more representative or more similar to what they are currently experiencing. Therefore, they overreact, overweighting, those signals, those states, causing overreaction. Right? So, for example, people tend to be overly optimistic if they are currently in a good economy, and in bad times, people tend to be overly pessimistic about the future. So this kind of overreaction has been quite widely documented in the literature across many different settings, most of those findings are based on the forecasts by individuals, such as investors, analysts, professional macroeconomic forecasters, etc. But we don't have too much evidence about those biases at the institutional level, and no prior research has really looked into banks' forecasts about their own forecasts of future performance, there's no evidence about whether or not banks' own forecasts are subject to the overreaction bias. And in our mind, this is quite an important gap in the literature, perhaps more so in recent years after the adoption of the current expected credit loss model, CECL, in 2020, which is the new accounting standard that governs banks' loan loss provisions, right? So under the new accounting standard, CECL, banks are required to provision for their lifetime expected loan losses. So compared to the previous regulation, it is a significant extension of the forecast horizon that is required for banks' loan loss recognition, right? And you can imagine by requiring more forecasts to be incorporated in banks' loan loss provisions, then any bias in those forecasts would play a bigger role in influencing the quality of loan loss provisions. And a particularly, interesting and important finding in the recent CECL literature is that because banks cannot anticipate turning points over the economic cycles. So, by requiring banks to extend the forecast horizon when they recognize loan losses under CECL, right, would actually amplify the procyclicality of their loan loss provisions and lending so that it can have the potential to increase systemic risk. If you think about that, one potentially important factor that can contribute to this inability to anticipate cycle turns would be this overreaction bias we study in this paper, right? If banks keep thinking that the future is going to be very similar to what they are currently experiencing, then it will be hard for them to anticipate something different, right? To anticipate a turning points in the business cycle. So by studying this behavior bias, we are contributing to this important policy debate about how CECL is going to affect banks' performance, about banks' loan loss provisions, about their lending, and how CECL is going to have financial stability impact. More broadly and at higher level, I think our paper also addresses the call from Helen, Young, and Zuo in their recent survey paper. I think that's a super important survey paper that basically calls that as accountants, we should really treat the people dimension with equal importance as other economic dimensions when we try to explain accounting phenomena. So we take this people dimension quite seriously in this paper, and we try to understand whether banks' forecasts about their future loan losses are subject to this overreaction bias, right? And if so, we want to take one step further and trying to understand how this bias resolves over time and whether or not this bias also affects banks' loan loss provisions, especially under CECL. So how do we do that? How do we detect this overreaction bias? Well, we follow the very commonly adopted approach in the literature formalized by Koibing and Goroning-Jinko in the following way, right? So this is the idea. In the first step, we need to make sure that we have our target, which is the realized loan losses in LCO in the future, right? That is measured just as the net loan charge-offs scaled by average loan amounts. Okay, this is our target. And now let's assume at time t, a bank makes a forecast about the realization at t plus h, right? This solid blue dot is my prediction at time t. I'm predicting something happening at t plus h. Okay, and the loan losses actually realizes at t plus h with this, indicated by this red triangle. So with those two numbers, we can calculate forecast error using the actual minus the prediction. And in this example here, we have a positive forecast error. Now let's assume 4 quarters ago, the bank also made a forecast about the same future realization at t plus h. So back then, the bank was more pessimistic. And so from t minus 4 to to time t, I changed my view, right? I changed my prediction of the future realization at t plus h, and this change represents a negative forecast revision. So I define forecast revision as my current forecast minus my previous forecast, all about the same realization at t plus h. And so in this case, in this example, we have a negative forecast revision. So now, if you think about a rational world where there's no behavioral bias, I can be optimistic at time t, right, relative to t minus 4. But if I'm rational, then when I revise down my forecast about that future realization, whether or not this solid blue dot is above or below this red line, right, whether or not my new forecast is higher or lower than the realization should be random. Because nothing at time t should help me to predict a forecast error that is realizing at t plus h, right, in the future. However, if we find a significant negative association between error and revision, meaning that whenever I become more optimistic, I revise down my forecast of the future loan losses, that's all good, but I always overshoot, so that my new forecast at time t is always below this red line, leading to a positive forecast error. Then that indicates I'm overestimating. I'm overreacting to whatever information I use for this new updated belief. Okay, and vice versa. If whenever I revise up my forecast, I always overshoot, and that leads to a negative forecast error. That's also an overreaction. So very simple for this. Although this is an AER paper, but if you look at the strategy of identification, you just need forecast error and forecast revision, and to test whether they are negatively associated. It sounds easy, but the data is not easy, right? So how do we get forecasts about banks' expectations of the future loan losses? So we are very lucky to have the access of this confidential data database from FRY 14A filings. So those are the filings that largest banks in the U.S. banking system provide to bank regulators under the stress test requirements. Okay, so those forecasts include key performance metrics. Every year at year-end, it is predicted at year-end every year. And for some years and some banks, we also have mid-year forecasts that help us enrich our analysis. So eventually, we have a sample of 22 largest banks in the U.S. banking system from 2014 to 2022. Now, let me highlight a few very important features of the data that allowed us to do many interesting analyses about banks' forecasts. Okay, so first of all, the predicted NLCO, the forecast coming from the Y14A filings, they're defined in the exact same way as the actual NLCO, right? So we can match them apples to apples to calculate forecast error using actual minus the prediction. A second unique feature is that every time a bank makes a forecast about the future, it always predicts each of the next 9 quarters, so that we have multi-horizon forecasts that will allow us to calculate forecast revisions also for multiple horizons. I'll show you that in more detail in the next slide. And the last point is that under the stress test requirement, banks are required to file their forecast of their future performance under both the stress scenario and a baseline scenario. So in this case, in our paper, we use the baseline forecasts because those forecasts are required to reflect banks' expectations about the more likely economic conditions in the future. And so those forecasts are reasonably close to what banks really believe what will happen under the most likely situation in the future. So we take advantage of the unique data structure to design our regression models. So I'll use a quick example here to illustrate the idea. So let's assume a bank predicts its future loan losses at year end of 2016. And as I mentioned, every time the bank predicts, it predicts each of the next 9 quarters. So we have 9 data points about the forecasts. And then 1 year later, at year end of 2017, the bank makes another set of 9 forecasts, also in the next following 9 quarters. So you can quickly see that there are 5 overlapping quarters that are predicted in both years. So we take advantage of that overlap to calculate 5 different forecast revisions. And of course, we can collect actual data about the realization from the publicly available data source to calculate forecast errors. And then we have forecast error, forecast revision. We run this regression, regressing error on revision. We can do that by pulling together all the 5 horizons. We can also separately look at each horizon. We will do both in our analysis. And if we find a significant negative beta 1, that will be our evidence of overreaction, right? Finding a negative association between error and revision. Okay, here are our main results. We basically find a very significant negative association between error and revision. And this result is quite robust no matter how we change our fixed effect structure or control variables. Right? This is by pulling together all 5 horizons. That's our full sample. So after documenting this baseline result, we want to take one step further and trying to understand the nature of the overreaction bias. So here we run basically the same regression, but separately for each different horizons. We regress forecast error on forecast revision for 1 quarter ahead forecast in column 1 here, and column 5 is 5 quarter ahead forecast. So as we move towards longer horizon forecasts, we see that the negative association between error and revision gets stronger. Right, so this is not a unique finding in our paper. This pattern has been repetitively documented in the studies of overreaction biases, and this is consistent with the representativeness heuristic argument about why this happens. Right, so the fact that longer horizon forecasts are more biased is basically consistent with our observation that it seems to be quite challenging for banks to anticipate cycle turns or to predict long-term loan losses. So now we have the overreaction. The next step we want to do is to understand how this overreaction resolves over time. Okay? So for this analysis, we'll be looking at all the forecasts targeting at the same realization at time t. Okay, so time t is the realization, and we look at as many as forecasts as possible all about the realization at that time point. So for that analysis, we take advantage of a subsample of our observations that we have not only year-end forecast, but also mid-year forecast, so that we can have up to 5 different forecasts for the same realization at time t. That happens when time t is the first quarter in a year. So if time t is the first quarter in a year, then the quarter before would be the year-end forecast about 1 quarter ahead. And then t minus 3 would be the mid-year forecast from previous year, and so on. And right, with those 5 different forecasts, we can calculate 4 different forecast revisions. Right, the first one being the t minus 7 revision. And that's the change from my t minus 9 forecast to t minus 7. And then we have also t minus 5 forecast revision as well. So what we will do here is to analyze the autocorrelation of those semi-annual revisions. And here are the results. If we start from the very last column here, column 4 here, we are regressing basically t minus 5 revision on t minus 7 revision as illustrated in the figure below here. Okay? 2 important findings from this column. One is that there's a significant negative association between the revision, between the more recent revision and the previous revision, which tells us that, whenever I update my new revision is in the opposite direction as the previous revision. And the second important finding is that the magnitude of the coefficient, the absolute value of the coefficient, is smaller than 1, which indicates that my more recent forecast revision is having a smaller magnitude compared to the previous revision. And we run the same regression for t minus 3 regressing on t minus 5, and then t minus 1 regressing on t minus 3 in column 3 and 2. And the last column is basically regressing the change from t minus 1 to t. This is the forecast error of t minus 1, regressing that on t minus 3 to t minus 1. So we look at the whole picture, and we find the same pattern. We have a negative association, and the magnitude is smaller than 1 in absolute terms. So these results collectively tell us that there is a continued presence of this overreaction bias as banks, keep updating their beliefs over time about the same realization at time t. And at the same time, the magnitude of the overreaction gradually shrinks as banks get closer to the realization. Okay, so the last set of analysis, what we do is trying to understand how this bias affects banks' loan loss provision. So to do that, we follow the prior literature to take a 2-stage approach. In the first stage, we basically regress forecast error on forecast revision to calculate this fitted forecast error, which captures the forecast error that is driven by the overreaction bias. And in the second stage, we regress loan loss provision on the fitted forecast error, as we reported in this table here. So if we start from column 1 here, using the full sample, we find a significant negative association here. How do we interpret that? Well, bear with me. Let's do that step by step. That means that whenever bank revises up their forecast of future loan losses, they overreact, and so that's an overestimated loan loss. That overestimated loan loss is associated with a negative forecast error because error and revisions are negatively correlated as we documented before. And then this negative forecast error is associated with an increased loan loss provision because of this negative coefficient in column 1 here. So net, what we find is that whenever banks overestimate their loan losses, basically whenever they are more pessimistic than they should be, they also tend to increase the provision, which is consistent with the idea that the bias is indeed affecting loan loss provision and the influence is in the same direction as the bias. Okay, in column 2 here, we look at years in and before 2017, which is a subsample that is is not affected by the effect of CECL. Basically, neither the forecast nor the realization happens, after 2020 in this subsample. So it is not affected by CECL, and we don't find this effect anymore. And then we move on to column 3 here, and we look at the full sample again, but this time looking at the interaction between the fitted forecast error and an indicator of CECL adoption. And here we find that basically the effect of this bias on loan loss provision is concentrated among CECL adopting banks after CECL adoption, which is quite reasonable, right? If you think about CECL requires banks to extend the forecast horizon for loan loss recognitions, and what we found earlier on, that the longer-term forecasts are more subject to this overreaction bias. Okay, and then we look further into this issue, and this time we look at the triple interaction between the fitted forecast error, the indicator of CECL adoption, and also an indicator of banks holding longer maturity loans. And we find that this effect of bias on CECL adopting banks is more pronounced among banks with longer maturity loans. Right? Again, very consistent with the idea that those forecast bias is more pronounced among longer horizon forecasts. And also it suggests an interesting behavior force that contributes to the CECL literature's recent finding that CECL has a stronger impact on banks with longer maturity loans. So we conducted several additional analysis trying to enhance our inference, trying to provide more evidence about the robustness and also the prevalence of the overreaction in banks' loan loss forecasts. We find that overreaction in the loan loss forecasts of the loan losses of different loan types, basically the same overreaction across different loan types. Secondly, we find the same overreaction during the pandemic. Third, we look more into the more granular MSA level forecasts of local macroeconomic conditions that allowed us to take more stringent fixed effect structures, and we find consistent overreaction in the forecast of those granular MSA level macroeconomic condition, specifically house price index. And lastly, we find that we find a stronger overreaction bias for MSAs where the bank has a greater branch presence. So this is consistent with recent findings in this literature that documents an overreaction gets stronger when the forecasters have a greater ownership or care more about the underlying data process that they forecast. So in conclusion, in this paper, we document a pretty robust and strong overreaction in banks' loan loss forecasts. We document the continued presence and gradual resolution of the bias over time when banks keep updating their beliefs. And we find that overreaction in forecasts affect banks' loan loss provision, especially after CECL adoption. Thank you very much for your attention. I look forward to Scott's discussion.
All right. First of all, thanks to the conference organizer and the editor for giving me this opportunity to discuss this very interesting paper, Imperfect Expectation in Loan Loss Forecast, that Yao Lu did a great job presenting. Brent and I both got our PhDs from the Ohio State, and I'm a big fan of Ohio State Buckeyes football. So instead of talking about Toronto Blue Jays losing, in the World Series, yes, I'd like to talk about Ohio State Buckeyes football. So, as you know, Buckeyes won the 2024 college football playoff. And ever since the preseason last year, they were considered a national title favorite due to their very expensive and loaded roster. And they performed just like national title contender until the very last game, the game against Michigan, where they lost to Michigan 10-13. And as you can expect, the fans were devastated, and they wanted the head coach, Ryan Day, to be fired, claiming this is the worst loss in recent memory. However, after this loss, they won 4 consecutive games, including in the postseason, including the championship game against Notre Dame. And after this, commentators argue, maybe fans overreacted to this Michigan loss, and Ryan Day is owed a big apology. Okay, so the fans' overreaction may reflect this representativeness bias, where this representativeness is a judgment rule where people assess an event's probability by how much it resembles the parent population or the prototype, overlooking this actual loss of chance. In this case, fans may have associated this loss to Michigan to a typical losing season and thus believe OSU and Ryan Day are the kind that cannot win the big ones, overlooking how great they have played during the whole season. The other behavioral biases can also explain this overreaction, such as the recency bias, where the fans may have placed an overweight on the latest game versus the other games in the season. Or they may have this availability bias, where a vivid rivalry loss just dominates their judgment and memory because this feels much bigger than the other wins. Or they can have this loss function of symmetry, where a loss hurts twice as much as a comparable win feels good. In addition, herding, social proof, or other behavioral biases can also explain this overreaction. Another possibility, though, is that this loss to Michigan may have prompted Ohio State to reflect on their games, and they made adjustments to their games accordingly. And this strategic change may also explain their postseason success. And that's why many commentators say that this loss to Michigan is perhaps a blessing in disguise that fueled Ohio State to win the postseason. So the narrative here is that fans either overreact because of this behavioral bias, or this game change may have explained the postseason success. And we are going to approach this paper based on a similar approach, where we argue this overreaction in charge-out forecast may be explained by either behavioral bias, including representativeness or other biases, or this can be explained by economic behavior, such as strategic and regulatory factors. Before I dive into my discussion, let me quickly summarize their finding. Based on the confidential Y14A filings by 22 largest banks subject to stress testing, the author find this negative association between charge-off forecast revision and forecast error. And they interpret this negative error revision coefficient, beta 1, as evidence supporting bank overreaction. In addition, they find this overreaction affect loan loss provisioning in the same direction as the focus bias, especially for CECL adopters. And they attribute this overreaction finding to this particular behavioral bias representativeness. In the first part of my discussion, as outlined in the orange boxes, I will first talk about banks' information environment and whether we can really attribute this finding to behavioral bias, and if so, whether representativeness is the only interpretation. The paper is in part motivated by this Alfrasi et al. QJE paper that model behavioral-driven overreaction. And I'm going to rely this theory paper to guide my discussion as well. In their model, they assume that the agent is aware of the most recent observation, but is given incomplete past information, such that they cannot process past information perfectly, which leads to overreaction. In contrast, when in a sticky information environment, when agents are given complete past information and allow them to use past information to form their belief, then overreaction goes away. Related to this, Giannaioli and Schleifer further argue that overreaction tends to occur when agents have local thinking and have to form quick and intuitive inferences. Different from prior studies experiments where agents tend not to have complete past information, banks actually have a full set of past information, and they clearly understand the data generating process of their underlying variables, including charge-off, provision, or anything, you name it. Okay? So this is the first difference. In addition, even in labs, when agents are visually and conceptually informed about the data generating process and given past information, overreaction also declines. Further, banks do not need to form quick and intuitive inferences. They definitely can spend time doing sophisticated data analysis. On this very last point, we use a simple AR1 model to calculate the predicted charge-off. And the reason why I use AR1 is because this is the data generating process in the theory and the experiments. And what you can see here is that the predicted value based on this AR1 model tracks the actual charge-off pretty well. So given this information environment and their data sophistication, we wonder why banks still overreact. And so this is our first suggestion to the author. I think they should provide more discussion on banks' information environment based on their data sophistication. Why do they still overreact? Now, the next question we ask is this overreaction really a behavioral bias, or does it reflect a rational expectation? Alfrasi et al. Provide more guidance on this. They argue if the overreaction finding is driven by behavioral bias, then this overreaction should be stronger for less persistent processes when underlying variable has lower autocorrelation and for longer forecast horizon. And the rationale here is that when the shock is mostly transitory, captured by low autocorrelation, then the gap between the behavioral weight and the rational weight will be the largest, which leads to an overshoot in the forecast revision. That also explains why the future error tends to go the other direction and why we see this negative error revision coefficient. And this effect should be stronger when forecast horizon is longer. So I think it's important for the authors to specify the nature of the information shock. What is the shock we are talking about? Is it transitory or is it permanent? That may affect the extent of overreaction. So ideally, I think the author should test whether this overreaction varies with charge-off autocorrelation and focus horizon. In Table 3, they did look at how overreaction depends on focus horizon, so that part is addressed. But they didn't do anything about charge-off autocorrelation. I reached out to Yao Lu naively asking, can I have that confidential data? I really would like to know. Whether this overreaction depends on charge-off autocorrelation. He said no. So given how obsessed we are, we conducted 2 analyses to shed light on this prediction indirectly. First, we don't have the confidential data, but we have equity analyst provision focus data. So we use this data to analyze whether equity analysts also overreact to provision in the provision forecast And the reason why we do this is because provision and charge-off, they're highly correlated. Perhaps they share the same similar data generating process. Specifically, we ask whether they overreact and whether their overreaction depends on the provision autocorrelation. Second, we use their Table 7 analysis on loan types to conduct very descriptive, limited cross-sectional analysis to shed light on this prediction. So this is the result for our analyst provision forecast. We do find a negative error revision coefficient, especially in the later period on average. So that's consistent with the overreaction finding in their paper. More importantly, we find this negative association is attenuated when bank has higher autocorrelation in loan loss provision. So this is consistent with the behavioral interpretation that the authors use in the paper. However, whether we can generalize this finding to this setting is unclear. One, analysts definitely have different information endowment compared to banks. Two, analysts may work in individual, not as banks that work in a team, where that prior research document that teamwork may mitigate the overreaction as well. Moving on to their Table 7. In their Table 7, they find negative error revision coefficient across different loan types to show that their result is robust to loan types, which is great. But we wonder whether we can take advantage of the variation in the negative coefficient here to shed some light here. So real estate loans has the most negative error revision coefficient. Based on the paper and Alfrasi et al., this suggests banks have most overreaction for real estate loans and least overreaction for C&I loans here. Based on the theory, we would predict real estate loan charge-off should have the lowest autocorrelation, while C&I loan should have the highest autocorrelation. Well, data doesn't seem to suggest that way. The charge-off for real estate loan has the highest correlation, and C&I loans have the lowest autocorrelation. This high autocorrelation for real estate loan is actually consistent with my prior. That would be what I would expect. So the two pieces of evidence or the analyses we do here are not completely consistent. So based on this mixed findings, we really suggest the authors to, one, specify the nature of the information shocks. Two, directly test whether this overreaction is really driven by behavioral bias versus rational expectation. And let's say the authors are able to establish that this overreaction is truly behavioral driven. The next question we ask is, why the representativeness bias? Especially, there are so many different behavioral biases that can give rise to overreaction. To answer the question, we come back to Alfrasi et al. Again, where they argue in their overreaction model, they draw on two key findings in the psychology literature. One, among available information, agents tend to use the information on top of mind, which is the availability bias. Two, among the information they use, they tend to include recent data, which is the recency bias. So based on this discussion, at least these two availability or recency bias may explain their overreaction as well on top of their representativeness bias. In addition, the authors operationalize this representativeness bias by using the extrapolative overreaction, which is the outcome measure, but not a direct test of the representativeness bias. We argue if you really want to isolate this representativeness heuristic, then maybe you should directly test the classic characteristics of this representativeness bias, including base rate neglect, sample size insensitivity, and prototype similarity. Okay? In addition, the representativeness bias depicted in the paper feels narrower than the general description of this bias in a textbook, which in our mind can create some confusion. So our suggestion for the author is that perhaps they need to think about how they want to frame or label their findings. After all, what they document is overreaction as an outcome of this potential bias, But if they're not able to isolate this one empirically, then maybe you should relax on the reliance on this bias and allow other biases to also contribute to overreaction. And that's why we went through the tables and find the other alternative biases that can co-explain the finding. Now, let me move on to the economic interpretation. First, the authors find that the negative coefficient varies a lot in 18, 19, and 20. In 2019, it increased significantly, but then it dropped significantly in 2020. And we find this, autocorrelation in charge-off cannot explain their finding. The authors argue that the year 19 result is driven by government guarantee provided in 2020, and the 2020 result is overreaction to the COVID fact. First of all, we are not sure whether you can really label this as overreaction or representativeness. For one thing, COVID is unprecedented. I don't know what is the prototype or what is the parent population in this example. In addition, if the result is mostly driven by 2020, do we worry about whether we can generalize these findings to the other setting? And as you can see, public health authority, bank regulators, they will argue COVID is unprecedented, it's unique, it may last for a long time. Banks also have similar arguments saying, the ultimate scope is unpredictable, we don't know how long this is going to last. So all of this uncertainty may explain why they are conservative in their charge-off forecast in 2020. So from the high side, sure, it feels like they overreacted. But if we live in that moment again, all the high uncertainty may really lead to conservative forecasts at that time. Now, let me move on to strategic investment. Banks can also change their investment strategically after experiencing these shocks. For example, they can reduce their risk-taking after experiencing higher than expected losses. And this lower risk-taking may be translated into lower charge-off in the future, which explain this negative error revision coefficient. So what we do here, empirically, we want to know whether that's a case. So we partition banks into 5 different quintile based on the amount of charge-off. On the left panel, I look at whether they reduce their loan investment in the next quarter. On the right panel, I look at their risk-weighted assets change in the next quarter. And what we find here is that when banks experience high charge-off, they reduce their risk-taking immediately. And that can explain lower charge-off in the future and the error revision coefficient. Also interestingly, when banks report very low charge-off, you actually don't see them increase their investment in the future, which may explain why they have this asymmetric findings in the error revision coefficient in some of their tables. We think this strategic investment is definitely a plausible explanation, but this interpretation doesn't necessarily rule out behavioral bias because we can interpret this bank's strategic investment as potentially banks overreacting to bad news by cutting down risk-taking. This is definitely a nuanced interpretation than that provided in the paper. Finally, regulatory pressure. We wonder whether the purpose of stress testing with a focus on tail scenarios may also bias banks' attitude toward more conservative forecast. And this argument is supported by this anecdote where Federal Reserve identified Deutsche Bank's loss projection approach to be a significant deficiency in their stress test evaluation, suggesting regulators do pay attention to loss projection that may lead to this bias. And this may also explain why their average forecast error is always negative in every sample year, especially in 19 and 20. Okay, how much time?
A minute or so.
Okay, a minute or so. I'm going to skip some of this analysis. Okay, so based on our discussion in the second part, we suggest the author first to tone down the overreaction to COVID argument because it does feel like a hindsight argument. At that time, maybe their conservative forecast is definitely well justified economically. They can also be creative and combine economic factors and behavioral biases For example, regulatory pressure may lead banks to be overprudent, overreacting by cutting down too much risk-taking. And that's why we went through the tables again by adding other economic factors they may consider to explain their findings. In conclusion, I think the paper is very interesting. There is a potential for them to make contribution to the literature because at the high level, they are the first first paper that brings behavioral explanation to the banking setting. So I really like it from that perspective. If they feel like representativeness bias is the only explanation, they need to empirically roll out rational expectation, economic behaviors, other behavioral biases, which in our mind is a high ask. So we suggest them to perhaps allow other explanation to also explain their finding. So best luck to the paper. And Darren, you're Michigan grad, but you are working for Ohio State. You're going to agree with me. We are not going to have another blessing in disguise this year. Okay, go Bucks. Thank you.
You want to just take a minute or two and respond? Yep.
So my first job in the U.S. Is a security guard at the Michigan Stadium. When I was a master's student at U-Michigan, that helped me get my SSRN, and I had a lot of fun seeing students burning their houses after, after we lose to Ohio State, and then next day they win and they burn the house again. So. People just overreact. They never had the right expectations. So go blue, everyone. But thank you so much, Scott. That's wonderful discussion and a lot of excellent points that are well taken. So let me very quickly, representativeness heuristic, why? I mean, this is just at the center of the behavioral explanation to the literature on credit cycles, on the original financial crisis, and we relied on that literature, both theoretical and empirical evidence, to guide our research design, and we find pretty consistent patterns documented in prior literature. And so, definitely many other, rational, irrational theories can explain part of our results, and we definitely need to do more discussion on that end. But collectively, our findings are generally consistent more with the representativeness than potentially other explanations, but all the points are well taken. And regarding regulatory pressure, I guess the key here is that conservatism itself doesn't necessarily lead to this negative association between error and revision. And more importantly, institutionally, regulators, they don't encourage or they don't actually want banks to be overly pessimistic in crisis, which can increase systemic risk and cause panic, and that banks also don't want to show weakness when they are in a crisis. And so, but we need to clarify a lot of those points and many other points you kindly suggested. But thank you so much.
John, Cor?
Yeah, so interesting paper. I just wonder, banks care a lot about their capital ratios. They care a lot about the loan loss provisions. And there's evidence they manage earnings to do these things. Why isn't the story that somehow these earnings management activities don't turn into forecasts that look like they have this representative bias when it actually is just good old earnings management?
Yeah, that's a great question. And so that is the luxury we had. Basically, this is confidential data that we can provide to Scott. And also, no one else on the market can be seen. And so it is really, from that perspective, there's no market pressure for banks to really manipulate those findings. And what regulators...
The earnings management just turns into these forecast errors somehow. So if you started off with the primitive of earnings management, you would get this kind of pattern in forecast errors.
Right, so to further mitigate that concern, I guess one thing we did back in the appendix, let me see. Yeah, so we need to verify, right, whether that number is indeed So what we did is we look at those forecast errors, and we regress that on a bunch of bank characteristics that can be potentially related to their agency incentives and stuff. And we don't find anything, right? Size, if you believe, too big to fail, right? Capital ratio that might be related to their incentives. They're not loaded. Are we surprised by that? Actually, not that much, because these are errors. They are supposed to be random, and if they don't really have an incentive to manipulate them, we don't find an effect here.
Steven, Glazer?
It would be good to see the full distribution of the charge-offs area, because it's bounded at 0 and 1, and if only one side of those bounds binds, it can lead to some statistical biases that could cause issues. And then second, you say that the managers have no incentive to be conservative or opportunistic, but their errors are reliably negative, right? So they are conservative. So what kind of explains that?
Right, so we asked, and it is possible, we asked the examiners, it is possible that they are facing some regulatory pressure, as Scott mentioned, that they might be negative, they might be conservative. But the fact that being negative or being conservative alone, it doesn't predict negative association between error and revision, and that's what we document.
That matches what you say in the paper, but that's helpful. Thank you.
Travis?
Yeah, so one of the things that I was, and I might be stealing a little bit of Clive's thunder because I saw his hand go up here. So Clive, jump in. We were talking about this earlier too. When you're measuring the dependent independent variable, like mechanically there should be a negative correlation because one of them has negative forecast error and one of them has negative forecast. You're subtracting, and then the other one has the variable as positive. And so I dug into that AER paper, and Clive did it way deeper than I did, so listen to Clive about this, but it seemed like I couldn't understand why it wouldn't mechanically be negative in just how you're calculating and running this regression. So my hope would be you'd be very explicit in a revision of what assumptions must be true for this not to be negatively correlated.
Right, we'll definitely explain that more clearly. We do have an analysis, robustness analysis on that. But let me start by with this picture, right? So this is the Schäubing and Gröning-Twinkle idea is not only to test the negative association or overreaction. It can also be used to test underreaction. If whenever I revise down my forecast, it is always above this red line. And that's a positive correlation, and it can happen equally likely. And so this is a test which, it doesn't necessarily give you a negative association. You revise down, it doesn't necessarily give you the negative revision correlation. But what can happen, to your point, is that if my prior forecast is already very close to the realization, right? That is the case when I'm looking at shorter horizon forecast. In that case, if there's any random noises going on here, that can mechanically lead to this negative association. And that is why in one of our tables, we did something like this. Hold on. Right, so notice this is still the forecast error and forecast revision test. The difference is that the current forecast is different. So the forecast error here is still 1 quarter ahead forecast. It's my actual minus my realization, but all about 1 quarter ahead. And the revision is my revision of 2 quarter ahead forecast, right? So these are, all made, those forecasts are all made at the same time, but we are looking at different horizons. So in that case, the current forecast in error and the current forecast in revision, they're different. And so that mechanical relationship will be gone. And we didn't invent that. That's in one of many Andrew Schleifer's papers. I believe this is an AER paper that they used this approach. And they found pretty much the same thing. If you look at longer horizon forecasts, because the previous forecast is less likely to be very close to the realization, you have the effect. While for shorter horizon, you don't have that.
Was your question, Clive, related to that? Or?
If I can elaborate a little bit? Okay, so the AER paper that you reference is doing something very different to what you're doing. So what they're doing is regressing the aggregate forecast error on the aggregate forecast revision. Okay. So their approach makes kind of sense because in a rational expectations world, the average forecast error should be 0. But you're not doing that, right? You're looking at the individual forecast of each bank. You're not looking at aggregate forecasts issued by many forecasters. So that means that you do have a negative mechanical relationship between the dependent variable and the independent variable. And so the reason for that is that your dependent variable is actual minus a current forecast. And then on the right-hand side, you have forecast revision, which is a current forecast minus a lagged forecast. It's trivial mathematically to show that these are mechanically related. You can just decompose the current forecast revision into a current forecast error and a lagged forecast error, and then you can clearly see that what you're doing is regressing a current forecast error on the negative of a current forecast error. Right. So you've basically got the same variable embedded on the left and the right-hand side, and then you've correctly pointed out here that in this table, because you're not using the current forecast revision, you're using the lagged forecast revision, so you shouldn't find significant results, and that's what you've got in the first two columns. I don't know why the other columns are significant, so I don't have a good explanation for that, but the first two columns are consistent with rational expectations.
Right.
So you shouldn't say in the paper that in a rational expectations world, we expect 0 correlation between the current forecast revision and the current forecast error. Right? That's just mathematically incorrect.
I don't think so, right? So this is exactly ruling out your concern in the sense that the idea for this analysis is that I'm making a forecast right now at year end of 2016, right? I predict 1 quarter ahead. I can also predict 2 quarters ahead. So if I'm optimistic about the future, I'm optimistic about 1 quarter ahead forecast, also 2 quarter ahead forecast. So this is really just trying to capture, right, this revision, for example, H2. It's just trying to capture my, sentiment. And the problem is that if I use H equal to 1 in the revision, and
briefly interrupt. So this table, I agree, right, is not contaminated by the mechanical relationship. My point was that in your paper, you say that in a rational expectations world, the current forecast revision should not predict the current forecast error. That is incorrect. Mathematically, that's incorrect.
That's, let's take a look at this again, right? So,
Take a look at it very quickly.
okay. If you always have that overreaction right here, at time t, the realization happens at time t plus h. So if there's anything, you can always predict that, okay, whenever I revise my belief, I always have a positive forecast error. Then in a rational world, I should revise less downward. This is the idea behind Koenig algorithm.
In a rational world, lagged variables should not predict current forecast errors. But that's not what you're doing. You're not using a lagged variable in your main empirical approach. You're using the current forecast revision to predict the current forecast error. So you're not using the lagged forecast revision for your main results. You do in that other table that you just showed, but in your main results you don't.
This is...
Give it some thought, right? I can promise Clive they will be giving it some thought.
But this is a very important point. Thank you for bringing that up. Thank you.
Yeah, so let's assume we take your findings at face value, and then I feel like one reason why we care about the provisioning and the forecast of the loss is because how it affects lending activity. So I guess I want to push you more towards also looking into banks' lending behavior, especially because you're using kind of Y14A data, and there's originating from the same data source, right? There's the Y14Q, which is loan level data. So you could also look at firms' actual banks' actual lending behavior as a result of this. And I also believe that you get forecasts of the probability of default and the loss given default at kind of the loan level. I'm not sure how good that loan level data is, because like you can't access it. But perhaps it's like worthwhile to think about kind of like that loan level forecast as well.
That would be an excellent idea for, future research. Unfortunately, this project needs approval by both the OCC and the Federal Reserve, and that's the only data we get approved for. But what we did is something related to what you asked. We looked at bank level loan change, and we didn't find anything. Right, so if you look at whether the bias will affect banks' lending at the aggregate level, we didn't. Using the same approach, we didn't find any effect. There can be many different reasons, right? Whether this empirical approach is the best way to identify whether we have, this data is not granular enough, and also this, how to really look at the pass-through from belief, expectation to real actions. This is really, frontier in this literature that we still not so sure about. And so it's a very important question for the future research to resolve. What we know currently is that the pass-through from expectation or belief to real action is very weak, way weaker than predicted in the theory, even under a well-controlled lab environment.
Joe?
So I had a similar reaction to Scott and Stephen in that I was surprised that the regulator allows these biases to persist over time, even when they're required to scrutinize the accuracy of the forecast really closely. So I was wondering if you could talk here and in the paper about what disciplinary mechanisms there are that the regulator could impose on the banks to get more accurate, and whether they are asymmetric versus whether the bank was too conservative or too liberal in their provision and forecast.
Right, great question. So what regulators do is that they monitor the accuracy of the forecast very closely for both capital regulation purposes and also for risk management purposes. They have examiners, they have supervisors go into the bank and look at both their model, whether the model is sound and reasonable and justifiable, and also the numerical forecast. But what they actually look at is the accuracy of the forecast. They don't penalize banks for being overly pessimistic or overly optimistic. Right? They look at measures like mean squared error, and they try to improve the accuracy of that. And so, that's what we learn from the regulators. That's the incentive, the regulator trying to improve the accuracy, but they don't really. And especially for over pessimism result, I think that's a strong evidence showing that this is quite behavioral, because regulators, they don't really want over pessimism during the crisis. And if you want to know why this happens, nobody really pay attention to that. Maybe they need to read this paper. If it's a bias, if it's agency issue, that's easier because you have check and balance from different stakeholders, right? Shareholders, depositors, regulators, they have different interests compared to the managers. But if this is a behavioral bias, everyone is biased, right?
Very much like the paper, Yao. Thank you for bringing this data to the literature. Part of the reason I like it because it carries implications for procyclicality and financial stability. So I was curious if you can push the paper a little more on the dimension. And specifically, one thing I'm curious about is how these errors co-move across banks. How these errors co-move across banks. Is this phenomenon primarily idiosyncratic? So banks are overreacting in different directions, and when you aggregate, then nothing much is left, or they kind of tend to move with each other. If it's the latter, and if it's a significant component, then the implications are way stronger.
So you mean if their overreaction is just idiosyncratic, or if they have systematic? Right, that's a great point, because one thing we try to mitigate identification concerns is that we have some. No, I understand. So we had, for example, time fixed effect, bank fixed effects, and our reviewer kindly pointed out something like you said. Well, macro trend can also be an important pattern that contributes to the overreaction, and the overreaction, if we observe that, in aggregate level, that also will be very important. So we remove all those fixed effects, and we find the same result. So I do, agree with you that I think this is more than just affecting the stability of individual banks. It is having a systematic impact.
So in my opinion, instead of throwing that, that's the thing to study.
I agree. Thank you. Yeah.
Similar, like going in Rahul's direction, like what are sort of the implications for procyclicality and actual lending? Like so far, like you pushed it into the provisioning, but can you actually show how this actually flows through into lending, and whether these biases actually persist into lending as well?
Right. So we didn't find effect, as when I was answering Fabian's question, right? So the pass through from expectation to real actions, very surprising to me, but it seems that this is really cutting edge, in the behavioral finance and economic literature, that people just find it a puzzle why the pass through is so low, and it is just much weaker even in the lab environment.
Okay.
I found paper quite
No. Well, that was no. It was Ava. Sorry.
So, so you, in your presentation and in your paper, you acknowledge that there are prior papers that have found a similar over-reliance on recent information, recent experience, highlighting that those were individual level forecasting studies. And then you motivate part of why you move to the bank level as sort of, well, it might not, or it may not prevail in the same way in the bank level. Now, to fully understand whether it could or could not prevail at bank level, I would have loved to see way more explanation about the internal forecasting process that's playing out here. Are there multiple individuals collaborating on this? Is the group dynamic changing these biases? Are they relying on some of the models? They have their own models, I read. The Fed has some scenarios that they're putting forward. Like, what exactly is happening internally there in that process? Having more insights into that would then also help me to start thinking about what can be remedied potentially to undo that bias in the future.
That's very very insightful and very. I mean, that's the direction I think the literature is moving on, trying to think about ways. I mean, what's the sources of the bias and how to mitigate that, especially for financial stability purposes. We talk to examiners and supervisors. It seems that they don't have a big data set on how exactly this is measured or forecasts are made. Like, for important things like GDP forecast, for example, we ask them, okay, where do you get your GDP forecast? Even among the largest bank, some have their in-house macroeconomic team to make that forecast. Some use Moody's forecast, and they don't have time series data to track. Otherwise, we would love to use that. So, but we would definitely provide more discussion along this line, trying to understand how this bias comes up. But it is well documented in the psychology literature that individual biases, by aggregating them together, it doesn't necessarily go away, and so that builds tension. But ex ante, we really don't know. In terms of how to mitigate or to resolve this issue, I think there's development in this literature. One JFE paper this year is talking about this issue, and Christiana Vidinova from UT Austin, her job market paper is also about incorporating this bias into CECL and into capital regulation. These are all theory papers, and I'm really bad at reading theories, but what I learned from this literature is generally that because this bias is causing excessive procyclicality, so it is useful to have early intervention by the regulators to have some kind of counter-cyclical capital regulation, and the capital regulation should be more stringent compared to the situation without those biases. Thanks.
Thanks. So yeah, I was wondering the following. If I try to put the corporate finance literature to work for this, so in corporate fin, there's both underreaction and overreaction, and I think it depends on things like the horizon and also how big the surprise of the event is. So what I would have thought might be happening here potentially is, and maybe this isn't the same as most corporate finance settings, but if it is, I would have thought there might be actually underreaction in the revisions unless there actually is a turn in the cycle by the end of the horizon being forecast. So I actually wonder if you could somehow look at that. Like, is it the case that when you're on average finding overreaction, it's actually only there or mainly there when there is a turning point within the horizon, and the trouble is really all about forecasting the turning point, but that the revisions themselves, absent that turning point occurring, are actually underreactions to the more short-term news maybe?
Right. We had that question, and that is why in one of the tables, we do look at different sample cuts. For example, not here. So
you got a table for everything.
You said you only accept high-quality papers, so so basically we look at years before 2017, and this is reasonably a quiet period of time. It's after 2014 and it's before 2017. It's neither the forecast nor the realization is affected by the CECL adoption or the pandemic. We find a similar result here, and so we don't think that this is only driven. Well, of course, we find a very strong effect during the pandemic. That's the forecast made at year end of 2020, when people are already aware of this impact of pandemic, and people are very scared about that. Even when banks' loan loss are actually getting better. Loan losses are declining. So it's really like overreaction to the expectation of a bad economic condition rather than simply extrapolating from my history. If I just simply extrapolate, I will be actually expecting something very opposite. Yeah.
So my question is related to Eva's point on the remedy. So if I'm thinking about it, I'm actually curious about the cross-section of banks, right? Is there any banks that are doing a better job, or put differently, is the results concentrated in a subset of banks? Scott's discussion talk about like if the forecaster have access to all the past information and then run like a simple AR1 model, you got a pretty good understanding of the future kind of charge-off, right? So my thinking is that, for example, are there any banks who are invested more into some data-driven approach, and perhaps they could do a better job? And also for these banks, very large banks, we also know that their information system are very complex. Yesterday during the discussion, right, even the SEC don't know about the insider trading filings, right? So it's possible that for those kind of complex information system internally, it's also kind of hard for the forecaster to get access to the information and put that into the data-driven approach to get a better estimate. So maybe those kind of dimensions in the cross-section will be worth exploring.
Right, that's in your CECL paper, and we learned a lot from that. So like banks do change a lot of their information processing, especially for large banks in our sample, right? When there's a need, when there's something changing. So that's absolutely an important point. I think that's why when we started this project, we asked about, okay, where do they get all those forecasts? They say some is in-house, some is S&P 5, Moody's, and we were so excited saying that, can we get that data? And basically Partha is telling us that, this is just based on my talking with those banks. I just know that, no data, no actually record anywhere. So it's something we hope to do in the future, and it's an important question. Thank you.
Maria?
Thanks. So I fully agree with Scott. The nature of the information shock is not clear, and this actually leads to potentially misattributing the effect to a cognitive constraint, where I think there is, similar to Scott, there is low-hanging rational explanations for what you observe. It's nice that you have the split across loan types, but for example, issues such as forecasts about asset values, unemployment rate, these will all feed into the interest rate and will translate into how the banks make the forecast. So I'm not sure why you go straight to the cognitive constraints before you're actually looking at macroeconomic expectations about land values, which coincide with COVID, unemployment rates, and how banks fit them into how they form the interest rates. And two caveats I would like to point. First, when you talk about the effect on exposed loan growth, you're looking on balance sheet. You're not looking at the off-balance sheet. And the effect may actually go to off-balance sheet items. So off-balance sheet securitizations, off-balance sheet unused credit lines, et cetera, et cetera. So you cannot really conclude that forecast errors do not map to loan growth. And second, one assumption you're making is that the forecast error revisions is not coinciding with changes in loan contracting. If the loan contracting changes and then you link this to exposed loan loss provisions, then you may misattributing the forecast, the fitted forecast error to exposed loan loss provisions, where what you may be capturing is strategic updates on how banks update their contract structure. So that's something that you want to point out.
Thank you. A lot of those, I think, questions are related to the cross-sectional variation and stuff that can help with that. I think we can definitely think more about that. Thanks. Yeah.
Okay, we do have a few more questions, but unfortunately we don't have any more time, so we're going to cut it off there.
Thank you.
Thank you very much. Okay, don't go anywhere. Just noodle over what you thought were the best papers and the best discussions, and Christina is going to come assist me in hopefully making this work.
Yeah, no, it is
QR code? Oh, just do the PowerPoint. Yeah, well, easy.
Okay, you guys are sitting.
Yeah, yeah.
Okay, so now, is it going to be both on there? Christina will tell you how this works, rather than her tell me and me tell you, which will not work as well.
All right, well, it looks like everyone with their phones out already knows how this works. So either you can use your phone and go to the QR code, or if you're old school, you can type in pollev.com/JEConf2025, and there will be 2 questions in this poll, and you have a couple minutes to
A
answer
few
them.
minutes. And just to keep in mind, there's 6 discussants, but only 5 papers. We've made a decision in the past that editor papers would not be in the polling for best paper. So unfortunately, Joanna, although it may have been the very best paper, you cannot vote on your paper. And I don't remember, actually, Ed couldn't remember either what the prizes are, but they are 4 figures. But probably not sort of high 4 figures, less than $99,000, but somewhere more than $1,000.
I want to see the distribution.
Is there another page?
Maybe the paper titles are small. We'll figure it out.
But you will be able. Will I be able to announce it now? You think?
Give me like a minute.
Okay. Yeah.
Give me. I'm gonna end the survey soon, and then I'll see if like once it's ended, maybe
Then
I
it
can
pops up.
maybe I can see it. Yeah. But you think they're done? Let's see.
Does anybody need more time? Okay.
Yeah.
Few people.
I was thinking about how
Apparently, 4 people are still working on it. I think.
Yeah. So we're going to close it down. Too, so. All right. I think that's good. I'm sure those last 4 will not.
Okay. You're like so ready. Your response is great. Okay. Go back to, well, we can do this old school. Figure out.
Any school is fine with me.
Yeah, that makes sense. I always see like. Oh, I'm so sorry.
No,
that
it's
this
okay.
is like. I thought this would like show, Okay, so we have best discussant is Josh White.
Okay.
Independence at what cost? Okay.
But you don't know what the other one's going to be yet, or we'll figure it out. Okay. So if we could just get your attention for one more second.
Do you think is it bad if you announce the best paper later? Because I can do it, but I need to like. Okay, thank you. It's up to you. Sorry. I don't know why it's not showing.
Have a little in there.
Do you use poll everywhere a lot? No.
I don't.
Okay.
So we,
like,
we have the results for best discussant,
yeah.
but for some reason we have the results for the best paper,
Like, I
but
don't-
it's not summing them. For
Yeah,
us.
like
So
I can,
Christina's gonna
I
have to
can. If
tally
you
them.
give me like 5 minutes, like I can go tally it up.
If you just do auto filter.
Oh, okay, okay, good. Yeah. Okay. Yeah. Everything is fine.
Yeah.
Everything is fine.
Yeah.
I just need like a couple minutes. That's all. But I'm good.
If you do auto filter, it should sum it for you. Then you can order.
Oh my
you
gosh,
can sort them.
you are a genius. Okay. So
You just sort by something.
sort by. They're like. Okay.
Okay. Select all.
I'll do this. Apply filter. Auditing smart contracts. Okay, that's probably not gonna win, right? 15. Okay. Sorry, I knew it was gonna take a little time. Okay, that's even less.
That's good. That'll be easy.
Okay, maybe this one. This is like
17.
20, 22.
22.
Okay, well, this is not 22, but this is, let's see how many. 30. Okay.
Okay.
Oh my goodness, we have.
So it's the private.
Oh my
firm's
god.
paper?
No. This is 31. Okay, 31 is the role of accounting in.
Oh my gosh, is it that
The
close?
informal account. Yeah, it's close. Okay, let's recount.
That's it.
Private form.
We have a recount. Doing a recount. Make sure we're on
Yeah,
any
it's
chat.
off by.
Very
They
close.
won by one.
Very close for best paper. Do we have a?
We do, but it's by one vote.
You just don't like
Yeah, he is there. Okay.
He is?
All right. Very close polling. So, every vote mattered. At the very end, there were a couple people struggling to get the results in, and I'm not sure if they made it in. But everything's been counted. The best paper is Ramesh's paper on authors. And the best discussant was Josh White this morning. All right. Congratulations to those people, but congratulations to everybody else that had papers, the discussants. Everybody did a great job, as well as the questions from the audience. Most of them were quite good as well. So thank you for coming. Safe travels. Hopefully the airlines have settled down a little bit over the last few days, but thank you very much. Appreciate it.
I was like, oh my gosh. And then it was like off by one.
Yeah, I thought it was good. Usually it's a landslide, right?
All right. Bye, guys.